Hey, Dale, we can't hear you.
I was just
Can you
wondering,
guys?
me or Dale?
Okay,
Oh, there
I
he
know
is.
why.
There he is.
Hey, we
Hey
can hear you,
guys.
Dale.
Hey,
All
good
right.
morning. How are you guys?
Good
Fran
morning.
and Pratt, a lot of attendees today. They
I
must
thought it
want
was
to
a
know what we're.
ghost moving your charts.
Yeah, they must want to know what we're thinking here. So Ryan, why don't we start off with you? Pretty good break after making new highs in U.S. dollar yen. Heavy going into tomorrow's NFP. Could it eke out another shot to new highs? Or
It's
are we
possible.
breaking down?
Obviously got the Bank of Japan before
Yeah.
the NFP, which is going to be big enough. No, I don't think it's going to break down. I think we're just seeing, we've moved to the highs, people taking risk off the table. We've got two big events. We know what Powell's said and done. It's a bit of a reduction in risk coming here. Not much of a move anywhere really today. A bit of a pickup, bounce, cable, euro, dollar off their various lows, but nothing that doesn't look dead cattish, if you ask me.
Yeah, they both have tails here. I will say this, another low, like maybe towards the low 17s. If it happens, it won't confirm. And it could happen. And Euro has even bigger tail, acting weaker than cable. And Aussie actually has a lousy RSI setup, but better looking technical look. I think I'm going to be trying Aussie at 5.5. We get that shot down there. So the same thing happening in everything that got trashed. Gold trying to bounce, can't get through 1820, and silver, it's barely a bounce.
Yeah,
Nothing, real, nothing, no
it's a
trip to
similar picture,
Hollywood.
isn't it? Similar picture, different assets, different pairs,
Yeah,
different
yeah.
FX. Similar picture. Had made lows, but the bounces look very weak.
S&P too.
Yeah.
Okay, so we can't. Blake mentioned this earlier. I think he mentioned it last week before we rallied. Is that this is a pretty good line in the sand. Great day to have Katie Stockton with us. Katie's has some real. She does some real nice technical work and trading based upon the market. It's going to be interesting to see what she's saying here. She did talk about 3,900 support before it got there. I saw her on CNBC doing that. One thing about the metals is the platinum, although silver made a new low and gold almost did, platinum putting in a nice higher low. So that almost kind of confirms that when, or I guess I should say if, although I believe when, metals regain their footing, that here's your leader. Okay, so I think platinum's going to be the top performer if we get any kind of bull run in the metals. And S&Ps, I don't know, I look at this and almost looks like unless it gets bailed by a number, maybe it wants another test of this 3,900 level. So, or when I go to a 4-hour, and I actually scalped it on the long side yesterday, compared to some of the other things, the pullback has been pretty marginal compared to how much gold gave back and what's happened in currencies. So far it could be just corrective as well, and we hold above 39.5 and make another run. So everything's going to come down to the NFP, I guess, huh? Kman?
Hey, good morning, Dale, and good morning, everybody.
Yeah, and you said that
in...
early in the week. Now there have been some decent trading opportunities in between, but you said the day that's going to make the market is going to be Friday. So
I'd say so. Yeah, and possible double whammy for the yen tomorrow. So
yeah,
preparing the levels to do that for the time being. I'm staying away from the yen, but I'll likely be up for the Bank of Japan. And then see if we get like this double push one way or the other on the U.S. labor report tomorrow. In the meantime, I'm just nursing what I've got running, but it's rather crosses than the dollar right now.
a pullback in the end. I think the real important area is going to be this, about 133. This was kind of a breakout line. I thought 31 was, but it really didn't respect it. But 32 was, pretty important once it broke through, never looked back. 33.
Yeah.
Maybe we're coming back to test this. And I think if we get through 33, I think you're talking about a full-blown retest of the low.
Yeah, I think so. It really depends on what Kuroda is doing tomorrow. There are people expecting him, or at least, I mean, not ruling out the possibility him going out with the bang, and changing something to the YCC, or putting the minus 10 BP into positive territory, or at least zero. There's some people expecting that, or there is a percentage possibility that he may do something to ease his successor into the job. But base case is they keep everything still. But if they change, yes, that's going to be put a lot of pressure on upside pressure on the yen, I think. Yeah, at least in the short term, depending on how big the moves are, which should be incremental and in small pieces. But we never know. Kuroda has surprised in the past, right?
Okay. Silver, we covered. Copper, it's so whippy. But you know what? I have a bias, right? So my bias is, economic weakness and weak copper. But you look at this chart, there's nothing wrong with copper here. It's even though I have this pivot and it's on both sides of the pivot telling me probably just, shouldn't stop paying attention to it. It looks like a flag, it looks like consolidation. Of course, we have to start performing, but this is something that tells me we're close to an Aussie bottom, and we could still pull back to, 387, worst case 75, but this is not a bearish structure in my view. So this is saying that, the China reopening story, which people are saying the best is behind us, copper saying something a little different, at least for now, to me. Any thoughts on that? I know, Blake, you follow copper for those reasons, to keep your tabs on China. Or let me go to back to Ryan.
But I'm just kidding. Yeah, please go ahead. I'll be back.
All right. What about the yuan, guys? I know you guys are active. You trade the yuan. Is the yuan giving you any clues about what's happening in China?
It's not going with the expected pickup. I thought one might have strengthened a bit with, particularly with those decent PMI numbers that we're seeing, and if China's on the road to recovery, obviously there's a big dollar story going on underneath all that as well. But we're building a bit of a level up at the sevens again. Always going to be a big psychological level. You can see last time we were up there. Right, and the 7 big figure, just where those tops of those highs we're just knocking around at.
Right here.
Give or take a few wannies.
And it probably looks like it might be about 50% back or 61.8 back. Could this end up being a selling opportunity in this currency?
Yeah, I was looking for a short up there, and we got close. We got to like 99, 60, 70, I think we got, but it happened overnight. I didn't have any orders in. I didn't want to leave any orders in on that one. But it's one of those levels. It's always going to have a say in things when we move from it. It's actually the next fib is the 50 fib at 703.
Okay.
Of the move down from the 730s. But potentially building a bit of a range between 6.91 and this 7. If we're close to it over the NFP and everything, it's one of those ones you think, oh, do I want to trade it if it's 50 pips away over the NFP? But look at it, what happens after. If it spikes above but comes back in after a big move higher, then, maybe you look at that and take the fake and go with a short then.
It looks like the yen.
Yeah. Yes,
I noticed that the yen looks a little weaker, but similar patterns, right? Big break, retrace.
that shows
Big
you
break, retrace.
that shows you that it's a lot of dollar involved in this one, more than the other side, more than the one and more than the yen.
Okay. So, there were a lot of targets up around 105.80, 106, and here's the dollar. I think it did not blow out the 4-hour divergence. Let's see. It's not great. Another high would be better, and we won't take it out. Similar in the end. It wasn't a great divergence because, it was almost the same as here. But if it tried it again, the case would even be better to short the yen again. I'm saying short some into the BOJ. Got short over 37, but I took half, and I'd sell a big rally if we had another rally because I'm pretty bearish this pair now. I think that there's some pretty good downside, and we're in this peaking phase now. So we'll see what happens. Maybe the dollar could eke out another high, and US dollar yen can't. That would be a nice market tell on a preferred short if that happens. So if the dollar rallies towards 580 or so above this 550 level towards 106, and the yen can't take out the high that we made up here, that'd be a pretty good market tell. Maybe rally back to 37, because you almost have to call this a false breakout, right? 37 broke out, tried to close above it, held it, and now we're back underneath 37. So almost looks like a false breakout. I think yields are coming off with it, aren't they? Let's see. Yeah, no, not really. Steady, but I don't know. It's going to take a pretty strong jobs number to get to 408, I think.
It's still in the short end. The moves are still all in the short end. You got the ones and twos well above 5% now, sailing up.
Yeah. So
and
when does the inversion stop? When the Fed stops?
Yeah, probably. But you're going to see as soon as the Fed stops, and as soon as the market then moves to going back to pricing cuts again, because that's going to be the next big mover. That short end's going to collapse.
Okay, I want to give gold miner holders a little ray of hope. Newmont is beginning to diverge here, and again, even with the weakness yesterday, GDX still has not gotten to the 61.8 level. So we start closing back under 26. There's a problem, but still think this is, if I'm right about the yen, we're going to have a nice gold rally, and we're going to and I think yield should come off. I'm not saying a ton, but 380, and whatever performs, maybe it could last longer than a pullback of 30-40 bips in the 10-year. But everything's down to tomorrow. I certainly wouldn't do a lot new until 24 hours and a half an hour after that, 15 minutes after the number, after the dust settles. Let the dust settle. Don't get aggressive today, and get ready with all your levels, like Ryan says, and be prepped to react to the reaction. Don't guess on what the reaction is going to be. That's roulette. But to react to it is trading.
You know what else is trading, Dale?
What
is also, and this is like the advanced part of trading. This is where traders try to get to, and this is what experienced traders do, is also pre-positioning yourself ahead of what you think is going to happen. So, for example, we were just having this conversation with I was just making some comments actually on one of Kman's charts about yields, and we're talking about
grab them.
And I'm sorry.
grab the chart.
Oh yeah. I'll do this. And you know, the thing is like I was just saying in the chat room. And by the way, let me just kind of for those of you that never seen what our chat rooms look like, this is going to be our chat room. You can see Kman's just having a conversation in there, but you can go into like the sub conversations which would be inside of these threads, and you can see we have general chat room, S&P room, trades room, active trade room, Flownomics room, news and research, Spanish chat room. So we have plenty, but even inside of the chat rooms you can see like discussions. And we were talking about Kman's 2-year chart and the 2-year yields, and Kman, you can always jump in here too. But when he was saying there, when he was posting that, I'm like, I think I'm going to sell dollar strength tomorrow, like on any really good number. If we see a good number, I want to sell into it. Now, with that being said, you have to think about like, how do you want to pre-position yourself if you want to, and this is one of the things that I do as a trader is I say, okay, this week, even though it's tomorrow, this week, I think I want to be short the dollar. And if you're thinking that way, you're like, okay, well, ahead of, a couple of days ahead of the jobs report, you do what Dale did and you get short some dollar yen above 137. And let's say we get to, tomorrow, we're consolidating here. The number happens to be bad. Then you can always add your position and move your stop to break even. And if you, and the flip side of that is, if you're here ahead of the jobs report, your short is up here, you move your stop to break even. And then worst case scenario, you just, lost your profit. You didn't lose anything. So pre-positioning yourself ahead of a news event based on what you think is going to happen is another way that we as traders, kind of take an advanced approach to the market. Let me ask some of our advanced traders here, like Ryan and Kman and Dale and Stelios and Steve. What do you guys think about pre-positioning yourself ahead of the move? Let's start with you, Ryan. What are you thinking? Or how do you do that?
What, getting in ahead of the number?
Yeah, okay. You think that the Fed's going to raise rates by only a quarter versus 50. So you want to sell dollars, do you do it right at when the Fed, makes a move, or do you try to pre-position yourself a couple of days ahead of time, short dollars? What do you do that?
Well, speaking about exactly that on the flow show this morning, the market is now running well to the other side of the boat regarding the Fed, pricing 50s for March. I personally don't think they go 50 in March. I think they get themselves into all sorts of trouble reacting to what is in effect 1 month's worth of data. Although the obviously the NFP will be 2. But it depends on what the data does, and if the market goes too far on its expectations for a 50 in March, where the risk is. And if I don't think the Fed are going to go 50 in March, I know if they don't, that we're going to see the dollar sold and yields come down. So yeah, positioning, getting into something ahead of that, but you want to get in at the right level. That's what you say, that's the key to it. There's no point jumping in now selling dollars and we get a really hot NFP and you're 100 pips offside waiting to run into the Fed. So you have to take a bit, I wouldn't call it a gamble, but you have to make sure you assign what risk there is. CPI next week, dollar could be anywhere before the Fed. So let the data flow out. If it gives you decent levels to get into shorts, like you say, that you can hold them for a bit and ride out any other bad data, that's what you do.
Yeah. Okay. All right. Kman, what are your thoughts about that?
For this particular occasion, I'm
not this particular occasion, just in general. We can talk about this particular occasion.
I do it at times, and like Dale, for instance, picked a good spot in the dollar yen because 138 is a bit of a level as well, and so that's nice. And you can manage your position and go into an event with a bit more relaxed approach, because the max you can lose is your entry or whatever you want to secure your position with. But yeah, I sometimes do it, and well, I actually do it regularly. But
I do it all the time sometimes.
yeah, like for instance, I was already long Euro Canada before the Bank of Canada yesterday. So yeah, I do sometimes trade before events. Yeah, I'm not all the
100%.
time. I mean, in this particular occasion tomorrow, I'm not having anything in yen because I really think the potential for a big move is there, and we could still jump on it after the Bank of Japan.
Yeah. All right, Dale, what are your thoughts?
You know, I never used to. I'd be flat before these numbers, but I found it difficult because, you know, like you and I do a lot of other things besides trade, that on days like that, if it goes my way, I have a hard time. I might be in the middle of an interview. So
Oh,
I've
yeah.
started to, you know, just keep a piece on at least. So it, you know, it's not going to hurt me if the numbers don't go my way, because I'd add on to the position, but not a whole position. Just say maybe a third I'll go into a number with, which is a change from going in with nothing.
Right.
And then hoping I can react, and I'm not in the middle of inviting someone on Twitter to be on Face.
Yeah.
You know what I mean,
what we do is definitely challenging in that respect. But you know, that's where sizing for me really comes in. It's like,
yeah,
you know, reducing sizes has been life-saving, mentally less taxing for me in the last few years.
Less leverage is always for everyone.
Yeah, I mean, you know, not trading for a fund for the last, you know, couple or, you know, year and a half has been mentally better for me, for sure. All right, well, Stelios, what are your thoughts here going into
okay, good morning. So I'm going to compare two of my favorite things, trading and playing Texas Hold'em poker. So
yeah, you asked,
did you say strip poker?
Yeah, exactly. So you asked, do I go in trades ahead of data? It's the same as asking, you know, do you only play high pocket pairs when you're playing Texas Hold'em? It depends. You have to read the market. You have to read the table and your players. So what I do in the market is I look at what's priced in. And like Ryan correctly said, the market has now shifted to pricing higher probability, much higher probability, over 50 for the Fed. I don't think this is
70% chance, buddy.
Yes. So so I don't think this is. I don't think we're there yet. You know, he opened the door for it, but I think we're not there. You know, it only takes one number. We have a CPI and we have NFP this Friday. CPI is it next week. One miss on those, and I think 50 is out of the question. And I mean out of the question. So so it's going to go down to, no, I'm not going to say 0% chance, but from 70 or 75, whatever it is, I think we're going to go down to 30, and that's going to be a big move. So when I see the market go one way, leaning one way on something that I don't think is as probable as the market thinks, of course I could be wrong, right? We all take risks and we take educated decisions. On this occasion, I think the market has gone too far. You know, if we get a weak number on Friday, you know, get ready for action. So I am thinking,
and yeah, go ahead.
No, as I was going to say, I usually don't go in nothing sizable, excuse me, ahead of numbers. But this one tomorrow, if we continue this way, I think I'm going to do it. So I have to take.
And I'm with you. You know, and this is where, you know, this is where exactly what I'm talking about is I think that the market has almost gone too far with rate hike expectations. And, you know, the terminal rate continues to grind higher. And I think that pricing is getting a little obnoxious. So that's why on any strong number tomorrow, if we spike into, you know, like let's take the dollar index as, you know, going to be the best example here. By the way, if you guys haven't seen a technical view of the dollar index, so we completed the bull flag pattern that's been working for the last 2 weeks. So that's why, you know,
now we have a new one.
Well, yeah, we are developing a new one. Now we are at the 38% retracement. So this is when we start talking tomorrow. Porridge is too hot. Porridge is too cold. Is it little red writing? No. Is it the three little Which children's story is that? I forget. But anyway,
Goldilocks.
Is it Goldilocks? I don't know. They all like blend together. Maybe it's, since you haven't heard them in probably like me, I haven't heard them in like 45 years, so I don't know. Anyway, what I'm trying to say is if the data is really, let's say it's strong, but it's not super strong. So let's say, let's just talk headline number. Let's say we create 230,000 jobs. It's just a good number. It beats expectations or what the average expectation is. But it's not like a blowout number. It's not like 500,000 jobs. If that's the case, I think the dollar might actually spike up right into this 38% retracement right here, right into the top of this. You can see it's a 38% retracement, right? So we knock our head into new highs, and then relative strength, as you guys can imagine, would be divergent, right? And I'm mapping this all out for you guys. This is the type of stuff we do on the Morning Edge in about 45 minutes with all the ForexAnalytix subscribers, and we go through all the the basic analysis of the charts. But we hit a new high in the dollar index, relative strength divergence, and then that gives you a good setup for fresh dollar shorts. That's what I think. That's the way I want to play the dollar tomorrow, even though I'm going to have dollar positions going into tomorrow. That's what I think is going to happen. Do you guys have any other thoughts on expectations for the dollar? Because I agree. That's a long explanation of me agreeing what Stelios is saying. Steve, I heard your voice out there. What do you think?
I don't have something to add, mate, because I have the exact same opinion. I thought for a very, very long period of time that the market was underestimating the potential for hikes for longer and higher rates for longer. And I've been approaching the markets from that perspective. And now finally, after a long time, the market is at least fairly pricing the future. So in my opinion, there are no big opportunities at the moment. There is no apparent mispricing. So it's very hard. I do think that given the very, very recent mood, a 25 basis point hike will probably lead to a big reaction. So I understand where the rest are coming from, having to do with positioning ahead of the data. Personally, I'm not going to do it.
Okay. All right. Well, let's go around the horn really quickly. Just got like 2 minutes. Dale, you have an interview coming up, right?
Yep. Katie,
all right, cool. And by the way, for those of you that really want to be involved in the ForexAnalytix community, there's a couple ways to do it. You take a $1 trial of ForexAnalytix and try it for 10 days. Download the mobile app while you're doing it. Jump in our chat rooms. It's fun. Go do that. Or you can be involved in the trader funding program, which is by the way, I posted the video on how I passed a prop firm challenge, the trader funding program myself. So if you want to try to access our money, you can take an assessment, and these are the different account values. If you just don't have the ability to trade these types of accounts and you want to trade our money, well, check out the trader funding program, because when you do that, you automatically are included in the ForexAnalytix community, because we want you to succeed. I mean, because we take 25% of your earnings. So if you make money, we make money. So, we want you in our community to do so. You'll be in there for a certain period of time based on how much of an assessment you take. So make sure you check that out. Or the other way to do it is, and by the way, we just had data come out. The other way to do it, weekly jobless claims should be pumping here. The other way to do it is to be involved in the weekly jobless claims just miss pretty good?
I wouldn't say pretty good. I mean, in the grand scheme of things, it's rather minor, but they missed a little bit.
Oh yeah, yeah, I mean, they did. That is very minor. Continuing jobless claims coming out a little bit. It's interesting when this starts to get to the 300,000 mark, you're going to start to see some serious volatility in these weekly numbers. Anyway, I was going to say the third way to be involved in ForexAnalytix is to Ryan, can you post your NFP tweet? Because you guys guessed You guessed the non-farm payroll number. How many monthly subscriptions do we give away for those that people get the closest?
200.
We give away 200. Wait a second. I didn't sign off on that. I did not get my stamp my approval for that one. How many opportunities do we give to people? Three. So if you are with one of three people closest to the jobs number, make sure you respond to the tweet that Ryan put out. He'll put it in the link, and it's free. And if you're already a member, you guys know this and gals know this. If you're already a member, we just tack on an extra month of your subscription. So there you go. And by the way, I just interviewed Michael Boutros for the first time from StoneX today on Trader Summit. You guys make sure you check that out. It's a really, that was a fun interview. I think it's going to be posted here. If it hasn't been posted here yet, it'll be up here soon. Dale, have a great interview. Thanks, team. And, let's get prepared for tomorrow's non-farm payroll.
And you know how you do it, team? You got to know when to hold them, know when to fold them, know when to walk away, know when to run. You never count your pips. When you're sitting at the table, there'll be time enough for counting when the market's closed. And, no one better to give us some ideas about what to hold and what to fold than Katie Stockton. Hi, Katie.
Good morning, Dale. How are you?
Singing in a joyful mood ahead of the NFP. Anyway,
it's song. I love it.
It's so great to have you back, and there's so much ground to cover. And I recall seeing you on CNBC, I don't know, a few weeks ago, and you did say that this market rally carried a little further than you thought it would, and that 3,900 would be the battleground, which Thursday it was tested, had a nice 2-day rally out of it. So my question to you is the market going to hold this 3,900? What happens if it takes it out? Do you hold out any technical views that we could have a little bit left to the upside, maybe like 4,300 or something like that?
Yeah, I mean, listen, it was a very strong up move in January, and yet now most of it's been given back by the market, and it puts the S&P 500. Hopefully, can you see the screen?
Yes, we got it. Okay,
great. This is the daily bar. And you see here, this is our trusty cloud model. And the cloud is a great gauge. It's a very forgiving gauge of support and resistance, typically more forgiving usually than the 50-day moving average on a daily chart, and more forgiving than the 200-day moving average on a weekly chart. And that's what we've been watching as our key support level in here. So it previously was around 3,900, and it's actually risen over time such that tomorrow it is around 3,980. So at current levels, you can see how easy that would be to get a breakdown. What we're seeing from the indicators is more negative than positive, certainly. The oversold bounce temporarily preserved support, and it was actually off of a DeMark signal. If you see this 9, the green 9 was a minor counter indication that usually has implications for 4 days or so, or 4 bars before you get a resumption lower. In fact, you saw something very similar here, a 9 right near the cloud, brief bounce and failure. We hope it doesn't have to be this dramatic, of course, but there is risk, I think, if we do see a couple of closes below this cloud-based support.
Okay, so the takeaway is the DeMark signal was for a short-term rally, which it got. Doesn't add any conviction to the long side, and you're looking for cloud support. Could be taken out tomorrow on a strong or better than expected or as expected NFP and the numbers inside. So if we're going to take that out, let's say we do, Katie, and we take it out, what are you looking for? Maybe is 3,800 a possibility on the downside, or would we be on our way to take out the October lows if we start closing back under the cloud?
This is a weekly bar chart, so you can see
Okay.
really the same indicators, and you can also see how these stochastics are pointing down, which is really one of the primary reasons that we do think we'll get that short-term breakdown and see a little downside follow through. As you're well aware, in a range-bound environment, which arguably the market is in already, these stochastics tend to be really helpful and timely. They do force us to be a little bit more short-term perhaps than we want to, but in a range-bound environment, you can't really assert a long-term directional bias anyway. So we want to have indicators like this on our side. Now pointing lower. If we do see the breakdown, for us, there is interim support around 3,800. It's a minor level, but we think that breakdown would increase risk to this, which is 3,505. It's a 50% retracement of the uptrend off of the COVID low. It obviously captured the October low. And if you look back in this area, it did capture sort of a previous consolidation area. So a pretty strong support level. It is evident off of that October low. Our hope is that we see a higher low versus this level, but that's our sort of risk framework that we're working within.
Okay, and you made a great point, Katie, about that, it's shorter term. And, this whole market has offered great swing trade opportunities, but very frustrating for both bulls and bears to have long-term looking to catch the next trend when it's trendless. So you have to take what the market offers you. And what you're saying is you have to be tactical now rather than trying to be look ahead 6-12 months on a position. You have to shorten your time horizons and take what the market's given you.
That's right. And we do think this is a transition year that will allow the market to emerge from this bear market cycle. And yet, I think your point is a very good one, that it's frustrating for both bulls and bears. That's the nature of a trading range, where you have swings in both directions that can be somewhat harrowing, and also not really easy to leverage. If you're asserting positions, you really have to be very nimble in your positioning to take advantage of that type of environment. And some folks are completely attuned to that, but many are more long-term in their orientation. So I think the key here will be not to perhaps overtrade in this environment, to try to just keep the indicators on your side over your preferred time horizon. Know that it's okay to be out of the market, especially at a time when we have alternatives. There is an alternative now. So, we feel that there is
money.
5%. There's certainly an appeal to that when there's lower risk. So,
as you talk about this, I've noticed the narrative of the range trade gaining traction for the last few weeks. And right away, my mind starts thinking, well, everyone's embracing that we're in this range. They don't have to worry about a breakout from the range, just trade the range. That breakouts are going to happen on both sides, maybe first to the downside and then to the upside, because everyone's embracing we have a range now. I saw you before we had this October rally, and you were talking about the VIX, and it's something you rarely talk about, but you had come up with that you thought there might be a 38 target in VIX. I didn't know that you would make any kind of projections in VIX, but I'm curious how you came to that conclusion. And do you still feel that way?
Yeah, and it's tenuous, right? I mean, we have still a high volatility regime at hand based on the fact that long-term, this is the VIX on a daily, this support level is intact, and that's at 1845. You can see it's a very well-tested level. And, within that sort of framework, you have a short-term oversold condition right here. And that suggests that we'll see a bounce off of that support yet again. We saw this breakout above the 50-day moving average as something that would trigger that so-called sort of volatility event, is what I'm calling it, which would require that move into the mid 30s, right? So you can see, I mean, the resistance couldn't be any more well-defined, right? Where it just seems to have peaked right around that level. That defines the upper boundary of the range. And we still can't rule that out with this oversold reading, support
Yeah.
intact, a recent
It
breakout.
looked pretty good. It looked pretty good on that initial pop towards 24 and then gave it back. But it looks like closes over 24, 25. If you take the low at 17, is going to give you at least 32. And
and I mean, look at these past breakouts above the 50-day. They didn't yield necessarily that instant upside follow through. You would see an initial breakout and then a pullback. Here it was the 200-day, but a little breakout and a pullback. So it's not completely out of line with historical action from the bear market cycle, where you know, it would go against this, right? Would be if we've actually emerged from the bear market cycle, which would mean a sort of a newer low volatility regime that I think we would all certainly welcome. And what would be triggered?
That's history.
Yeah.
We all want to go back to the future. I mean, back to the past.
I know. And listen, we'd love to see that 18.5 area broken decisively, because that would tell us that this sort of higher volatility regime has a new lower floor.
Okay. So pay attention to the VIX. It looks like we're at one, you know, we're at critical support. It's one way or the other here for this as well. Your view on Dixie, Katie? We bottomed at par 55 and have rallied up to, you know, 5.5, almost about a 38% retrace of the big hit that we took from 114.5. To me, watching currency action over the last few months, and I know the dollar's getting a little bit of a bid here. The dollar has its gains have been hard fought, and only 38% at this point. A lot of people turning friendly, you know, going back to the milkshake theory, etc. Where do you stand with it trading back over 104, back over 102?
You know, I think we will see a little bit more upside follow through. We had a recommendation in our Substack newsletter in UUP, and we've stayed with that. But it is feeling like it's getting a little bit long in the tooth. And we say that in part because of this intermediate term overbought reading in the weekly stochastics. But notice also, I love this chart. It's a weekly cloud chart, and you can see the corrective phase came into support based on that cloud. And now it's towards the upper boundary. So right up in near the upper boundary of the cloud, and also per the 200-day moving average, which is somewhat replicated by the 40-week here. This is our resistance area.
106 level, the 200?
Yeah, it's about 106.5 or so.
Okay.
I can show you on this one. It did manage to get through the daily cloud. So that's why we're staying with our sort of dollar bullish recommendation for now. But you can see the upside, you know, is somewhat limited when you look at the 200-day being around 106.60. So I suspect that we'll see a little follow through, then it'll start to peter off. And we believe that the dollar overall, in the same way that equities we think are perhaps in a range bound environment, still with the lower bias initially, we suspect that the dollar and euro in turn have entered a trading range. And you can see this is on the monthly chart. Look at what happened to this monthly MACD. It's really converged. And then at the same time, we have just a neutral reading here in the monthly stochastics. Now, so to me, it feels like we'll probably see just a period of backing and filling. There is some support around 102. That's quite strong.
Okay. I think that what a lot of market participants might have a harder time wrapping their head around is the long end of the yield curve, something like TLT, especially with Powell talking like a mega hawk this week that really, you know, put pressure on gold and silver collapse. The dollar rallied, S&Ps took a hit. And yet when I look at TLT, so far we've left a bit of an island bottom there, and you know, off the lows that we had, I don't know, several months ago, it almost looks like a bullish pattern to me in TLT, that if we could get over a resistance area, you could be talking about a pretty massive bond rally. And I'm wondering, could we, if we get the breakdown in S&Ps, finally get old school reaction to where bonds can work in a risk-off environment instead of leading the market into a risk-off environment?
Right. I do think the point on the relative is certainly high conviction right now. And that if you look at this is the ratio of TLT to the S&P 500, there is a DeMark buy signal short term, suggesting that we'll get outperformance. Now we have to trust that this 200-day moving average, which has acted as very clear resistance for the ratio over the past cycle, that it will remain intact until it otherwise. But you can see a potential higher low with a relief rally in relative terms. So we feel pretty confident in the ability of Treasury, bonds and ETFs to outperform. And then to your point, that I see what you're saying with this island reversal. Now you also
and look to the left in December, it was the same way.
Yeah,
at the last low.
And
even doesn't this look corrective? Yeah, after that first launch, we've corrected in time, and a lot of time going back to November. That whole overbought situation, not as much in price as in time.
Yeah. And I do think that this October low is the start potentially of like a bottoming process. The emphasis still there is on process. I mean, we do have a reaction to a long-term oversold condition. But that would, of course, trust that yields are getting into a range of their own. We do have that bias where we think Treasury yields, they look higher near term. But when you look at the monthly charts, there's actually some signs of exhaustion on those same DeMark indicators that they have no implications for the next month or two, but they do suggest for the next 7 or so months that we will see just more middling sort of sideways action overall from Treasury yields. And listen, that would be a departure from, the trends that we've seen, of course. So a departure from this downtrend in TLT. We actually yesterday, just if you can sort of humor me here, we launched a new report. And it's called ETF Navigator. In this report, we have all the fixed income ETFs. So we're publishing this on a weekly basis. We're really excited about it. It was a labor of love, and then week over week.
Anything with love in it wins.
Yes. So each week we'll highlight these sort of US equity ETFs, going down all the way to the thematics like cloud computing, et cetera. This week we started our inaugural report with fixed income. So we showed all, TLT, IEF, even the muni bond ETFs. And here you can see them, they really are, of course, very positively correlated. SHY here on the right is coming into the support already, right? So this is 1 to 3 year sort of a representation there. And you see the oversold condition. So I would call that at a proving ground. And we do have some signs of short-term downside exhaustion as that level is tested. And here you can see other bond ETFs as still, being within their downtrends based on the weekly cloud with weakened intermediate term momentum. But notice here also, they are more oversold certainly than equities. And we feel that these ratios, so these ratios are HYG, for example, versus the spiders, you can see that they're range bound, but poised for an oversold bounce in following what we just saw on TLT.
Yeah, the further you go out on the curve, the more constructive the technicals are.
Yeah, I would say that.
So with this, are you a believer that we should be ignoring the message by the severe inversion in yield curves across the board?
No, you know what? I mean, we had the first inversion, in July of last year. And to me, it's reason to be cautious with equities because we don't tend to see the equity market bottom outside of a recession. So I think it's certainly something to be respectful of. And it just keeps us in that sort of risk off mode. And being wary of breakdowns, being respectful of downturns. So I don't think it's something to be ignored. It certainly is getting a lot of press just given the extremes, but it's already been an overhanging issue.
Okay, so during this recent run that we had, going back to the employment report, where 10-year yields went from 3.30 to 4%, 4.08. In fact, last Friday, the market came off. We've had a dramatic correction in precious metals, silver from 24.5, gold from 1960 to 1800. I started building a minor position yesterday. Am I crazy? Because I look at GDX, and as weak as the bullion has been, we haven't even retraced 61.8 in GDX yet.
Yeah, well, so GDX actually does have a counter trend signal. So somebody asked me yesterday if they should hold a position in Agnico Eagle, so AEM. And there's really not much redeeming about that chart in particular, but to keep in mind the top-down influences, which of course are quite strong with anything commodity related. This is GDX on a daily chart. As much as you can't make a case for it based on the indicators, the DeMark indicator here would suggest that it is overdone on the downside, at least short term. So these signals on the dailies will have implications for a minimum of about 2 weeks. So I want to give this signal in GDX a chance to work, just knowing that you could see some defensive positioning, of course, if we do get a broader equity market breakdown. And you can see on the risk level for GDX, it gives you a really nice defined, essentially stop loss. So at 25.97, an open below 25.97 on GDX would stop out that signal. And therein, I think, would be a fair stop loss.
25.97, just FYI, is 61.8 back, where I'm looking to add to my positions, not get out of my positions. So I'm just saying, maybe I should be getting out of my positions, but I usually give 61.8 a chance, and there'd be pretty good divergence between the last low. So anyway, that's how I'm structuring it. I think it's a buy zone. Then I'll find a stop after that, maybe, risk 100 or so to see if we get a turn. But that to me is a buy zone. But interesting that DeMark is showing it's way overdone for at least a bounce in there.
Yeah, we're definitely getting there. And this is another DeMark indicator that it doesn't have to be consecutive, but it could flash another signal either today, tomorrow, or early next week. And not all the signals are timely, but there's enough that are timely, like this sell signal, that it always, makes us kind of perk up.
Okay, so I mean, it kind of says cloud-wise that we could have a breakdown in the S&Ps, and probe lower levels. Bonds are shaping up for potential recovery on the long end of the curve. Gold could be there for counter trend moves. So I think we have it diagnosed, and I would think that if the dollar is going to rally one more time, it should do it then.
And I would just add on Dale that where things would look better, right? Because that's always something good to have in mind, especially with this volatility in both directions. This weekly cloud chart of the S&P 500 shows the resistance. It moves down to about 4,200 in a week or two. And that's pretty well aligned with the early Feb high. So a breakout, very simply, which we can all identify about that 4,200 area would start to really improve the chart in terms of resistance, but also likely have a positive impact on the indicators, which still at this point, point lower.
The only thing we can control, Katie, and that's knowing when things change and having your line in the sand for when things change. So great to bring up. Should always know when the picture is going to change technically in whatever you trade. How's the ETF going, Katie?
Yes, so far so good. In falling with our views, it is still sitting very heavily risk off. So we have the positions in the treasuries, short-term treasuries, long-term treasuries. It holds also GLD, so for gold exposure, and has stayed with energy, the energy complex. As much as we've seen a loss of momentum there, it still has maintained its uptrend, both in absolute and relative
terms. Are we close to it abandoning that? Because I looked at the XLE.
Right. Yesterday. Yeah, and that's the position as XLE. I would. So here we have. You can see on the monthly chart, and remember this is very long-term sort of strategy that we're we're using here. Look at just the slope of the 12-month moving average. You can just see it's not down and it's not even flat, but it certainly seems to be rolling over to some degree. We also have a DeMark issue here. The MACD is still positive, but has converged a little bit. So certainly some longer term indications that it is moving into more of a range bound environment of its own. And yet we do look for crude oil to get up into probably the mid 80s even. So we still want to stay with the exposure and leverage that, knowing that a lot of the energy stocks look poised for an oversold bounce and offer actually a lack of correlation to the S&P 500 that we're welcoming right now.
Should they break down, would only add fuel to the decline in S&Ps, don't you think? Since they were really the relative leaders forever.
They don't have a big footprint, but certainly could affect sentiment to some degree. What I will say is that the sector rotation that we're seeing from a longer term perspective is actually really promising. So if we look at, I'm going to try to pull this up here. If we look at the relative rotation graphs for the S&P 500 sectors, and if we take a 6-month view, you'll see that it's quite promising in terms of favoring the sectors that tend to exhibit leadership during bull market cycles. So, and of course, there's a major influence here from the mega caps, but it's communications, discretionary technology, still solidly in this lagging quadrant of the RRG. But here's the defensive sectors, and you can see that from this kind of 6-month perspective that they've taken a downturn. And that just means, it doesn't mean they're underperforming, that significantly, but it means that they've lost momentum. And you can see it in energy as well. So this shift, this tends to make this clockwise rotation. And it would be something that if you picture in the next 6 months that we could actually have something meaningful.
Okay. Who developed this?
This is Julius de Kempenaar. He's based out of the Netherlands, at least was when I last spoke to him. And it's his proprietary model. And it's a really fantastic, I'd say, data visualization tool. Yeah.
Yeah, I never saw it. It's like the wheel of asset classes.
Mm-hmm.
Spinning around.
Really cyclicality too. It's great.
Yeah, spinning around like a watch.
Mm-hmm.
All right. Well, I set my watch by a lot of things that you say, Katie. I think that you're one of the best out there. I turn the volume up when I see you on TV and appreciate your giving spirit. Best way for people to continue to follow your excellent work, and maybe something will happen in cannabis one of these decades.
I appreciate that, Dale. I mean, the easiest way to sort of get in touch is via our website. It's fairleadstrategies.com. And with this new report, folks might want to consider signing up for like a free trial. We give a month away, and we're hoping to get a lot of feedback on that to make sure that it's helpful. Okay, so everyone go to fairleads.com, Katie. Yeah, I can put it in the chat room. Yeah, why don't you do that? And you could follow Katie on Twitter at Stockton Katie. And I really love to hear what Katie's thinking as frequently as possible. So again, my Trading Warrior sister, and appreciate the tweet that you enjoyed this as much as I do, getting together. And look forward to 3 months of great trading before we speak again. I'm a fan. Can you tell? Too. All right, we'll send each other 8x10 glossies. And thank you, Katie, and thanks for putting up with my Kenny Rogers imitation. No, all good. Have a great day. All right, Katie Stockton, everybody. Take care. All right, everyone, you could join the team in 16 minutes on the Morning Edge. You're welcome, everyone, and glad to bring top elite type of technicians like Katie to you, and hope that you glean something that you could put in your toolkit and consider following Katie. Definitely, you should. And I don't say should a lot. So don't just count your pips, count your blessings. See everyone tomorrow. We'll trade the NFP, which should be no freaking problem. Adios.